When planning for retirement, Social Security benefits are a crucial part of the equation. However, there is a tax surprise that many retirees are not aware of: the Social Security tax torpedo. This sneaky tax situation can significantly reduce the amount of Social Security benefits you get to keep. In this video, I'll break down what the Social Security tax torpedo is, how it impacts your benefits, and the strategies you can use to sidestep it. Whether you are married or single, the cost of inaction is very high, so stay tuned until the end. Understanding and addressing this tax trap can make a huge difference in protecting your retirement income. Let's get started. Most retirees do not realize that Social Security benefits can be taxed. And to get a handle on the Social Security tax torpedo, you first need to understand how these benefits are taxed. Unlike other income, Social Security benefits are not automatically taxed. Instead, the taxability of your benefits depends on something called provisional income. This term is the key to understanding how much of your Social Security benefits will be taxed. Provisional income is equal to modified adjusted gross income plus tax-exempt interest, which is interest earned from municipal bonds and other tax-exempt investments, plus a half of your Social Security benefits. Depending on your provisional income, up to 85% of your Social Security benefits could be subject to federal income taxes. Your filing status plays a crucial role in determining when your Social Security benefits become taxable. If you and your spouse file a joint return, you have higher provisional income thresholds, allowing for more income before your Social Security benefits are taxed. Generally, if your provisional income is less than $32,000, none of your Social Security benefits will be taxed. If your provisional income is between $32,000 and $44,000, up to 50% of your benefits can be taxed. And if your provisional income is over $44,000, up to 85% of your benefits may be taxed. Single filers, heads of household, qualified widowers, and married couples filing separately but living apart are subject to the following provisional income thresholds. If your provisional income is less than $25,000, none of your Social Security benefits will be taxed. If your provisional income is between $25,000 and $34,000, up to 50% of your benefits can be taxed. And if your provisional income is more than $34,000, up to 85% of your benefits may be taxed. As you can see, single filers have lower thresholds, which means a larger portion of their Social Security benefits could be taxed, especially if they are used to filing jointly. Plus, people with substantial income in addition to Social Security might find up to 85% of their benefits taxed. When Congress decided to tax Social Security benefits, the goal was to recapture some of the benefits from high-income individuals who did not rely on them as much. However, because the income thresholds set in 1994 haven't been adjusted for inflation, an increasing number of Americans are now finding themselves taxed on their Social Security benefits. If your provisional income crosses these thresholds, the lesser of 50% or 85% of your Social Security benefits, or the amount by which provisional income exceeds the threshold, is added to your gross income for tax purposes. Let's look at an example to see how the Social Security tax works in practice. Let's say John and Jane are a retired couple filing jointly with an adjusted gross income of $30,000, and they receive $20,000 in Social Security benefits each year. To figure out how much of their Social Security benefits will be includable in their taxable income, we first calculate their provisional income. $30,000 plus half of their Social Security benefits, totaling $40,000. Since this is below the $44,000 threshold, only 50% of their benefits are taxable. The next step is to calculate the lesser of half of their Social Security benefits, which is $10,000, and half of the amount by which their provisional income exceeds the income threshold, which is $4,000. Since $4,000 is less than $10,000, they would have $4,000 of Social Security benefits included in taxable income. Now let's say John and Jane withdraw an extra $5,000 from their retirement account, increasing their provisional income to $45,000. This extra $5,000 pushes them above the $44,000 threshold, making 85% of their Social Security benefits taxable. The outcome, $6,850 of their Social Security benefits now count as taxable income, leading to a much larger tax bill than they expected. This is a prime example of the Social Security tax torpedo in action. The Social Security tax torpedo describes the sharp increase in taxes on Social Security benefits as your income rises. When your provisional income crosses certain thresholds, each additional dollar of income can trigger taxes not just on that income, but also on up to 85% of a corresponding dollar of Social Security benefits. This creates a torpedo effect where small income increases lead to disproportionately large tax increases, a real burden for retirees on a fixed income. It's important to understand that once 85% of your Social Security benefits become taxable, any additional income will not trigger more of your Social Security to be taxed. To illustrate this, let's take a closer look at John and Jane and how the Social Security tax torpedo impacts them. In this example, John and Jane receive $50,000 in Social Security benefits with no other income. At this level, none of their Social Security benefits are taxable. However, as they start earning additional income, things begin to change. Once their modified adjusted gross income plus tax-exempt interest reaches $23,000, their marginal tax rate jumps to 18.5%. This is because they entered the 10% federal tax bracket, and 85% of their Social Security benefits become taxable. In practical terms, an additional $1,000 in modified adjusted gross income increases their taxable income by $1,850. As their modified adjusted gross income continues to rise, their federal marginal tax rate increases to 22.2% at $35,000 and remains at that level until their taxable income exceeds $62,000. This 22.2% effective marginal tax rate is a combination of the 12% federal tax bracket and the tax on 85% of their Social Security benefits. Under normal circumstances, an extra $1,000 in gross income in the 12% tax bracket would result in $120 in additional taxes. But since 85% of John and Jane's Social Security benefits are taxable, that same $1,000 increase in modified adjusted gross income results in $1,850 being added to their gross income, pushing their tax from $120 to $222, which corresponds to a marginal tax rate of 22.2%. The modified adjusted gross income of $62,000 marks the upper limit of the tax torpedo, where $50,000 of their Social Security benefits are taxed at 85%. Beyond this point, any further increases in modified adjusted gross income won't result in additional taxes on Social Security benefits, and only the applicable marginal tax rate will apply to the extra income. Therefore, it's crucial to stay below that threshold to avoid higher taxes. Now that you know what the tax torpedo is, let's talk about how to avoid it. While wealthier individuals might not be able to dodge taxes on 85% of their Social Security benefits, those with more modest resources can take steps to reduce or even completely avoid this tax torpedo. In addition to managing your tax brackets and keeping your income within the lowest possible tax bracket, delaying Social Security benefits until full retirement age or later can be a smart strategy to minimize or avoid the Social Security tax torpedo. Not only does delaying often result in higher benefits and total income if you live past the break-even point, but it also reduces the number of years your benefits are taxed, as the torpedo tax only affects those receiving Social Security benefits. If you are still working in your 60s and earning enough income to trigger the tax, delaying benefits might be especially beneficial. If you are planning for early retirement, consider using your tax-deferred accounts, pensions, or annuities to manage your expenses while postponing your Social Security benefits for as long as you can. This approach often leads to better financial results when taxes are taken into account compared to claiming benefits earlier. Before you start receiving Social Security benefits, try to make gradual lifestyle adjustments and reduce your expenses. Paying off your debt, like a mortgage, can lower your retirement spending needs by thousands each year. If you're already receiving benefits, managing your expenses can help you avoid the Social Security tax torpedo. Focus on essential needs like housing, food, and healthcare. This allows you to reduce discretionary spending and potentially lower the amount you need to withdraw each year. If you are planning a major purchase, time it strategically. Rather than withdrawing a large amount in 1 year, spread the expense over several years or use alternative funding sources such as a home equity line of credit that do not increase your adjusted gross income. This approach is especially beneficial when selling significant assets or receiving a lump sum. If you are in one of the 11 states taxing Social Security benefits, consider relocating to a state that doesn't. Also, use your health savings account funds for qualified medical expenses in retirement. HSA withdrawals are tax-free and won't affect your provisional income. While I understand that downsizing, relocating, or cutting down your expenses is easier said than done, smart spending can help you avoid drawing on taxable income, keeping your provisional income below those tax torpedo thresholds. To avoid taxable income, keep your retirement accounts intact and let them grow tax deferred for as long as possible. When you do need to start withdrawing, be strategic. Delay withdrawals from your traditional IRA and 401ks and instead draw from Roth IRA accounts, which do not count toward provisional income. When dealing with required minimum distributions, the size of your retirement account can significantly impact your taxes. If you anticipate that your required minimum distributions will push you into a higher tax bracket, try making smaller withdrawals before turning age 73 to spread out the tax burden. This strategy can help lessen the effect of large required minimum distributions on your provisional income. In addition to that, consider spreading out income from other sources, such as pensions or annuities, as this can help you stay below income thresholds. For example, if you have a permanent life insurance policy, consider taking withdrawals or loans against the cash value. These funds are generally not considered taxable income and therefore do not affect your provisional income. Converting a portion of your traditional IRA or 401k to a Roth IRA before you start taking Social Security benefits can give you more time to perform Roth conversions and reduce the years in which your benefits are taxed. While you will pay taxes on the conversion, Roth distributions are not included in provisional income, so you can take withdrawals without triggering the Social Security tax torpedo. This strategy is most effective when you convert during years of lower income, like early retirement before required minimum distributions start. It can also help later by reducing required minimum distributions and easing the need for taxable withdrawals to cover retirement expenses. If you are charitably inclined and do not rely on retirement account distributions, a qualified charitable distributions allow you to donate up to $105,000 annually directly from your traditional IRA to a qualified charity. The donated amount doesn't count as a part of your adjusted gross income or provisional income, helping to reduce the amount of Social Security benefits that are taxable. This strategy is particularly beneficial for those who are over 70.5 years old and are subject to required minimum distributions. If you are still saving and investing outside of retirement accounts, consider using tax-efficient funds or investment vehicles that generate minimal taxable interest or dividends. Aligned with your risk tolerance, consider buying and holding growth-oriented investments that focus on capital appreciation rather than income. If you invest in municipal bonds to earn interest that is typically exempt from federal income tax and sometimes from state and local taxes as well, be aware that this interest is still included in provisional income. Nevertheless, municipal bonds can be a tax-efficient way to earn income without significantly boosting your provisional income, helping you avoid the Social Security tax torpedo. If you have capital losses, consider tax loss harvesting, which involves selling investments at a loss to offset gains and lower your adjusted gross income. Reducing your adjusted gross income can decrease your provisional income and potentially help you avoid the Social Security tax torpedo. Just be careful, as the IRS has specific rules for valid tax loss harvesting transactions. Some annuities, like non-qualified immediate annuities purchased with after-tax funds, let you receive a portion of the payout that's non-taxable, reducing the amount of income that counts towards your provisional income. Deferred annuities can also help lower your provisional income. For example, you can transfer $200,000 from an IRA or 401k into a qualified longevity annuity contract and defer income until age 85. This would allow you to delay required minimum distributions on that portion of your retirement savings, which can reduce your provisional income and potentially cut or even eliminate taxes on your Social Security benefits. The Social Security tax torpedo is a hidden trap that can significantly impact your retirement if you are not prepared. Understanding and planning for it isn't just about optimizing your taxes, it's about protecting your retirement income. Ignoring this issue could have significant consequences. For example, if you are not prepared, you could find yourself paying taxes on up to 85% of your Social Security benefits. This can result in unexpected tax bills that take a bigger bite out of your retirement income than anticipated. The financial hit from the Social Security tax torpedo can compound over time. As your taxable income increases, you may find yourself in a higher tax bracket, paying even more in taxes, and possibly losing out on other income-dependent benefits and credits. Higher taxes on your Social Security benefits mean less money in your pocket each month. This reduction in income can force you to draw down more from your savings or investments, potentially depleting your resources faster than planned. By not managing your provisional income, you risk eroding your wealth over time. This erosion can impact your ability to leave a legacy for your loved ones or support causes that you care about. Planning for retirement requires more than just saving money. You need to understand how taxes will impact your income. The Social Security tax torpedo is a prime example of how a little-known tax rule can lead to higher taxes on your Social Security benefits. By knowing how provisional income works, understanding thresholds, and implementing strategies like delaying benefits, managing expenses, or making tax-efficient withdrawals, you can reduce the impact of tax torpedo and protect your retirement income. That's it for today. If you liked the video, please give me a thumbs up and subscribe to my channel. And if you'd like to learn more about how we help our clients in protecting their wealth and maximizing the lasting impact of their legacy, be sure to visit us at www.lestna.com. Thanks for watching.